Hello and welcome to the first slide pack of the financial modeling program. The aim of this course is to give you core financial modeling skills for jobs in finance, in corporate America, in academia, to help with your academics, etc. And what we'll do is we'll start out with refreshing your understanding of financial statements and how they're linked, and then ultimately make you an expert on developing financial projections for business and financial decision making. We will also give you hands-on model development experience through projections for a publicly traded company, and give you practical tips on keeping your models real, in line with business and economic conditions, and specifically well reflective of projections for the company that you're valuing. We'll also make sure that your models are easy to use by people aside from yourself, such as your managers or decision makers, that your models are scalable so that tomorrow you can add more tabs and grow your model as needed, and that the models are robust in that your model does not break down if someone enters the wrong value or things like that. And then finally, we'll show you how to incorporate your model into business presentations. Now, a financial model basically looks at historical performance data for the company's financials, and we try and glean trends such as the growth in revenue, the margins that the company has, the debt that the company has taken on, etc., the capital expenses that are required in the day-to-day running of the business. So the compilation of historical data really gives us a baseline and an understanding of the business that we then use in conjunction with current business conditions, expectations for the future for both the company and the macroeconomy, and various assumptions and interrelations to make reasonable, realistic projections for what might happen in the future. Now, financial models are used in a wide variety of decision making in the corporate world. They're used for business plans, for budgeting, for project selection, capital allocation, etc. And actually more widely in the financial world, where models really are the basis of a lot of what goes on in Wall Street, for everything from stock valuation to arbitrage to mergers and acquisitions to buyouts, credit ratings, bond valuations, you name it, there's a model behind it. And in today's world, virtually every business decision can benefit from a financial model. So even in a simple small company in corporate America, if there's a decision between spending $50,000 on project A versus project B, financial models can help you guide that decision making. Now, it's important to remember that models cannot make decisions for you, and so you really should look at the model as a guide to your decision making and use your common sense to come up with whatever the right decision is. Now, a financial model has three components. There's the income statement, the balance sheet, and the statement of cash flows, or the cash flow statement. The income statement really is just the revenue or the top line sales of the company, from which you subtract out all the operating expenses, the tax expenses, the depreciation expenses, the any other expenses that you have, and then what you are left with is the net profit or the net income. One point I want to make here is that a lot of lay people use the terms revenue and income interchangeably, but as a financial modeler, we have to be very clear that revenue is the same as top line sales, which is revenue that comes into the company from the selling of goods and services, not to be confused with net income, which is what you're left with after you clear out all of your expenses. A balance sheet basically has assets, liabilities, and owner's equity. And a mnemonic for the balance sheet is aloe, as in creams and cosmetics that use aloe vera, ALOE. The A stands for assets, the L for liabilities, and the OE stands for owner's equity. Now, basically think of it this way. The company has assets, and once you cash in all those assets and you pay off all your liabilities, whatever is left flows to the owners of the company. So that's the owner's equity. So another way of thinking about this equation is assets minus liabilities equals owner's equity. So here you can use it in whatever form you're comfortable, as long as you fundamentally have the equation balanced. The assets typically consist of cash, investments, inventory, receivables, property, plant, and equipment, and any other assets that you may have or the company may have. Liabilities typically include things like the debt that's payable, the account payables, which you might have to pay out to the suppliers for raw materials, tax liabilities, etc. And then finally, the owner's equity has the initial capital that they put into the company, plus the retained earnings that have accrued over the years of operating the business. The cash flow statement is a fairly simple concept. It looks at the cash that you start the quarter or the month with, and then it looks at the cash flows in and out of the company through its routine operations, and at the end of the period, it tells you what the ending cash balance is. So as its name says, a cash flow statement really just looks at your cash flows through the period. Now what we have here is a sample income statement for Cisco Systems, which by the way is also the company that you will be modeling in your project exercise. The thing to focus on here is are not the numbers on the right hand side, but the line items on the left hand side. So this is just a refresher that the income statement at the very beginning has net revenue or net sales, which in Cisco's example is divided into products and services. From that, you take out or subtract the cost of your sales. So this could be things like the cost of the tin and the material and the chips, etc., that go into making some of their equipment. When you take out the cost of sales, what you're left with is gross profit, what Cisco calls gross margin. After that, you take out the operating expenses, and in Cisco's case, it's research and development, sales and marketing, G&A, amortization, and other in-process R&D. And once you take out all of your operating expenses, what you're left with is the operating income. Cisco, as it happens, has a lot of cash, so they actually invest a lot of their cash in debt or stocks or minority stakes in companies. So they have this interest income and other income that essentially reflects the investments that they've made, which must be factored in for every period, for every accounting period in the income statement. And then you have a provision for income taxes, and once you take out taxes, what you're left with is net income. Now, another measure that's very important for every company, but more so for publicly traded companies, is the earnings per share. This is a number that people, including the analysts on Wall Street, look at very, very carefully. And the earnings per share is basically just the net income divided by the number of shares outstanding. And there are two measures here. One is the basic number of shares, and the second one is the diluted number of shares. And realistically, the diluted number of shares really gives you a better reflection of the shares outstanding. And typically, the diluted number of shares tend to be slightly higher than the basic number of shares. So just to be conservative, if there is an EPS number that you must pick, or a net income per share number you must pick, I'd say go with the diluted number. Here is Cisco's balance sheet. Again, on the left side, you've got assets, which are broadly broken down into current assets and non-current assets. Current assets include things like cash that you can immediately sort of have available to take care of your expenses, accounts receivable, inventories. Non-current assets include things like property and equipment, goodwill, etc. On the liabilities side, again, you've got current liabilities and non-current liabilities. Current liabilities include short-term debt, accounts payable, taxes payable. Long-term liabilities include long-term debt, income taxes, and such items. Then finally, what you have when you subtract the total assets, when you subtract the total liabilities from your total assets, you've got the total equity. And as you'll see here, the assets equal the sum of the total liabilities and the total equity, which for 2008 is $58.734 billion. This is Cisco's cash flow statement. Now, a cash flow statement typically starts out with net income at the very top, and to that net income, adjustments are made for cash and non-cash expenses. So the first chunk of adjustments that are made are essentially related to operating activities. So things like depreciation and amortization, or changes in accounts receivable or inventory or accounts payable. And so you'll see that a lot of the line items here either come from the income statement or they come from changes in the balance sheet. So for example, the accounts payable is a difference in the accounts payable from the prior period to the current period. So when you adjust for all the operating activities, what you have is net cash provided by operating activities, which is one component. The second component is cash from investing activities. That could be from an investment into certain securities or into private companies. So that gives you the net cash that is used or provided by investing activities. And then finally, you have cash from financing activities such as the issuance of common stock, the issuance of debt, the payment of debt, and things like that. So when you add up these three cash flow components from operating, investing, and financing activities, you get the cash at the end of the period. Now, a typical model should allow you or the executives at the company to very quickly, in one glance, understand what's the operating income, what's key parameters, what's the earnings before interest, taxes, depreciation, and amortization, also called the EBITDA. What is the net income? What is the net margin, which is the net income as a percentage of revenue? What is the cash from operations? How much debt is this company taking on, and can this company comfortably pay off the debt? So there are a whole bunch of performance parameters that should very easily leap out of your model, perhaps in a summary dashboard, for decision makers to get a sense of whether this model is realistic. Now, as a model developer, you have a choice. You can either build a one-off model that's specifically for something that's going to be just used once or twice, and that's it. Or you can build a template that can be used repeatedly and expanded as needed. And generally speaking, it's just easier to build a template that you can tweak for one application or another than build one model and then go back and recreate another model and so on. So as a model developer, you need to thoroughly understand financial statements, how they're interlinked, and how they can be realistically projected. And this realism is what differentiates a good modeler from a bad modeler. And in fact, I'm reminded of the dot-com boom when you had analysts at the best investment banks developing model projections that was so completely out of whack with reality that bid up stocks on companies such as pets.com that had no income whatsoever, and yet there were projections out there of how great that company was going to be and why its stock was worth $100 or more. And all of that sounded great at the time, but 2020 hindsight, everyone looked back and said, what were you thinking? And so you've got to sort of make sure that your models are realistic. Now, Excel is actually a fantastic tool to build financial models because it has a lot of formulas built in. It's very easy to lay out. It's very numbers friendly. It's reasonably formatting friendly, and it's very transparent. And it's very robust and scalable if you know how to use it right. So Excel is a fantastic tool. And at the end of the day, you've got to be the architect that takes input from your various stakeholders and then analyzes that input and then comes up with a model that reflects what they really want to achieve. that is robust, elegant, scalable, and easy to use. So what I'd say is keep your model simple. And even though the situation you're tackling may be very complex, still break that complexity down into little chunks and keep your overall model simple. As you likely know, a financial model leans on a lot of assumptions, a lot of interrelations between parameters, and none of these can be accurately known 5 years or 10 years out in the future. So do not take your model results as the gospel truth, and do not say that the answer is X because the model says so. But just use your model as a guide to sound decision making, and you'd be on the right track. Now, just as an architect has to draw plans on paper before breaking ground and building a building that withstands earthquakes and wind and rain and things like that, likewise, you as a model developer need to play architect, and you've got to think about how your model is going to be used, what external factors are going to influence your model, how your model can account for variations which are inevitable in these external factors. So for example, if the risk-free interest rate is 4% today, something may happen in the world that could cause it to jump to 7% tomorrow. And your model should have a way of building in sensitivity to account for these kinds of factors. It must be easy to use, and it must be such that it's not overly simple and it's not overly complex. So you've got to think about who you're developing this model for and base its simplicity or complexity depending on the end users. And finally, every model must tell a story. So make sure your model has a start, a middle, and an end, and a logical flow to it, so that if someone just emails your model off to the CEO, when he opens up the model, it should almost be intuitively clear to him on how he can follow your model along or make changes as he needs to without breaking it down. And I can tell you, a lot of these guys love to play around with the parameters. So you've got to make sure you give them one place, one little sandbox where they can do all their playing that they want, and just make sure that your model is very robust in handling the changes that they want to make. Organize your model so that the input and the output areas are very clear. Like I said, make it a sandbox so that it's easy for people to sort of play with your model without breaking it down. And from your perspective and from the perspective of users, give your model a consistent look and feel. Use the same layout. Use the same structure for the sequencing of dates. So if someone looks at the income statement from the left to the right, if they just see the years increasing, say from 2009 to 2010 to 2011, but if they go to your balance sheet and the order changes, then that's not something that's going to make them very happy. So make sure it has a consistent look and feel. And what's very important is make sure that you only provide one input cell for any given variable. So if you want to make a change on the interest rate or any one assumption, there is only one place where anyone can make that change. A few more sort of recommended best practices. A lot of times financial formulas can be very long, and it's very easy to mess up the parentheses and think you've got the formula right, but in reality you could be calculating something that's sort of different from what you intended. So a good rule of thumb is to break your formulas down into small components, and always avoid hard coding numbers into your formulas. So as an example, if you assume that revenue growth is going to be 10%, and if you hard code that 10%, but the CEO comes to you and says, I really think we're going to have a blockbuster year and I want the revenue growth to be 17%. Now, for you to go in there and say, I'm going to fix every one of those cells, and for you to sort of think about what you might have missed is painful. But if there's one little cell that you can go to and just change that 10 to a 17, you've saved yourself a lot of heartache and hopefully a lot of embarrassment and you've hopefully also impressed the people that you're working with, and your model is going to be off and running. Now, there are a few ways to minimize errors, and one very important tip is to use absolute references where you can, because we all are apt to copy our formulas, and if you do not use the $sign, which is an Excel function, then you end up with errors in your model. So, use absolute references carefully. Use Excel's F2 function to make sure your formulas refer to the right cells. Check the parameters on your function. So for example, present value is a very important formula in our financial models, and it has a parameter that's a type parameter, and a 0 for type means that compounding is at the end of the period. But if you put in a 1 for type, then compounding happens at the beginning of the period. And when you're dealing with a company with billions of dollars like a Cisco, the 0 or the 1 can actually have a very tangible impact on your numbers and could make your numbers wrong. So make sure you know your formulas very well, and if you're not clear, Excel has good help features provided that you can refer to just make sure that you are actually using the model correctly. Computers always crash, more so if they're Windows based. So make sure you save your work every 5 minutes or so, and also make sure that you save it either as a different version or as a backup file, because we've all been through instances where we've spent hours building a beautiful model, and then someone comes and changes something or deletes something and saves it as the same name, and voila, you have lost everything. So make sure you save your file as different versions. So with that, we end slide pack 1.